Welcome back to the channel. Today we're diving deep into a topic that's absolutely critical for any trader, regardless of experience: the psychological traps that can sabotage your trading success. You see, it's not just about charts and indicators. Your biggest enemy often sits between your ears. We're going to expose 14 of these mental pitfalls that can seriously mess with your trading decisions and eat into your profits. Get ready to take notes, because understanding these traps is the first step to overcoming them and achieving consistent success in the markets. Let's kick things off with a classic psychological trap: FOMO, the fear of missing out. You see a stock taking off and you feel the urge to jump in. FOMO pushes you to make emotional decisions. You end up buying at the peak just as the trend reverses. Trading is a marathon, not a sprint. Stick to your trading plan and analyze the charts. Overconfidence. Overconfidence is a slippery slope in trading. You have a few winning trades, and suddenly, you feel invincible. You start thinking you've cracked the code, that you can predict the market's every move. This dangerous mindset can lead to reckless behavior, like doubling down on losing positions or ignoring your risk management rules. You become blind to potential downsides, convinced that every trade will be a winner. But the market has a way of humbling even the most seasoned traders. Remember, no one has a crystal ball. Stick to your trading strategy, manage your risk on every trade, and never let a few wins go to your head. Loss aversion. Loss aversion is the tendency to hold on to losing trades for too long, hoping they'll magically turn around. It's like watching a sinking ship and refusing to abandon it even though you know it's going down. We've all been there, clinging to a losing trade, hoping to avoid the pain of admitting defeat. But the longer you hold, the deeper the hole you dig yourself into. Remember, cutting your losses is not a sign of weakness, it's a sign of discipline. Use stop-loss orders to automatically exit trades at a predetermined level. Accept that not every trade will be a winner and move on to the next opportunity. Chapter 4. Confirmation bias. Don't fool yourself. Confirmation bias is like wearing blinders. It's the tendency to seek out information that confirms our existing beliefs and ignore anything that contradicts them. For traders, this means only reading analysis that supports your trade idea or dismissing any negative news about a stock you own. You become so fixated on being right that you ignore clear warning signs. To avoid this trap, actively seek out opposing viewpoints. Challenge your own assumptions and be open to the possibility that you might be wrong. Remember, objectivity is key to making sound trading decisions. Chapter 5. Revenge trading. Don't let emotions rule. Revenge trading is like trying to fight fire with your bare hands. After a losing trade, it's tempting to jump right back in and try to win your money back quickly. But this emotional decision-making often leads to even bigger losses. When you're driven by revenge, you throw your trading plan out the window and act impulsively. You're more likely to take unnecessary risks and chase bad trades, digging yourself deeper into a hole. After a loss, take a step back, breathe, and reassess your strategy. Don't let anger or frustration cloud your judgment. Chapter 6. Anchoring bias. Don't get stuck on a price. Anchoring bias is getting fixated on the first piece of information you hear. In trading, this means getting stuck on a specific price level, like your entry price. You might refuse to sell a losing stock, hoping it will go back up, or hold a winning trade too long, waiting for an arbitrary target. The market doesn't care about your prices. Focus on current conditions, analyze objectively, and adjust your strategy. Herd mentality. Herd mentality is the tendency to follow the crowd even if the crowd is running off a cliff. In trading, this means buying or selling simply because everyone else is doing it, without conducting your own research. You hear about a hot stock tip at a cocktail party, see everyone on social media talking about a particular cryptocurrency, and feel pressured to join the frenzy. But often, by the time the herd catches on, the smart money has already made its move, and you're left holding the bag. Remember, successful trading requires independent thinking. Do your own research, analyze the fundamentals, and make decisions based on your own judgment, not the opinions of others. Fear of pulling the trigger. Fear of pulling the trigger, also known as paralysis by analysis, is a common trap that keeps aspiring traders on the sidelines. You spend hours analyzing charts, reading every piece of news, and waiting for the perfect moment to enter a trade. But the perfect moment rarely exists. The more you hesitate, the more likely you are to miss out on profitable opportunities. You become so caught up in finding reasons not to trade that you forget the original reasons why you wanted to trade in the first place. Remember, trading involves taking calculated risks. Trust your analysis, define your risk, and once your trading plan gives you the green light, don't be afraid to pull the trigger. Recency bias. Recency bias is like judging a book by its last few pages. It's the tendency to give more weight to recent events or trades, assuming they will continue indefinitely. For example, after a string of winning trades, you might become overly optimistic and start taking unnecessary risks, believing your winning streak will last forever. Or, after a few losing trades, you might become overly cautious and miss out on good opportunities, fearing that every trade will be a loser. Remember, the market is constantly changing. Don't let short-term trends cloud your judgment. Look at the bigger picture, consider historical data, and adjust your strategy based on a long-term perspective. Chapter 10. The Sunk Cost Fallacy. The sunk cost fallacy is like stubbornly finishing a meal you don't like just because you paid for it. In trading, this means holding on to a losing trade simply because you've already invested time, money, or emotional energy into it. You might think, I've already lost so much I can't sell now. But holding on to a losing trade in the hopes of recovering your losses can be like pouring money down the drain. Remember, past losses are irrelevant to future potential. Every trade should be treated as a new opportunity. Focus on the current market conditions, not the amount of money you've already lost. Chapter 11. Greed. Greed is like a bottomless pit. It's the insatiable desire for more, even when you've already achieved a significant profit. In trading, greed can lead you to hold on to winning trades for too long, hoping for even bigger gains, only to see those profits evaporate. You might ignore your exit signals, convinced that the trend will continue forever. But remember, trees don't grow to the sky. The market is cyclical, and what goes up must eventually come down. Set realistic profit targets for each trade and stick to them. Chapter 12. Impulse Trading. Stick to the plan. Impulse trading is like making a major purchase without comparing prices or reading reviews. It's entering trades without proper analysis, often driven by boredom, excitement, or a gut feeling. You might see a stock mentioned on social media and feel compelled to buy it immediately without considering the fundamentals or the current market conditions. This type of impulsive behavior is a recipe for disaster in the market. Remember, successful trading requires discipline and a structured approach. Always follow your trading plan, analyze every trade carefully, and never let emotions dictate your decisions. Chapter 13. Endowment Effect. Don't fall in love with your trades. The endowment effect is like valuing something you own more simply because you own it. In trading, this means holding on to underperforming assets just because they're familiar or because you have an emotional attachment to them. You might refuse to sell a losing stock because you've held on to it for so long or because it was your first investment. But remember, sentimentality has no place in trading. Evaluate your portfolio objectively and be willing to sell assets that are no longer serving you, even if it means admitting a mistake or letting go of something you're attached to. Chapter 14. Ego and Refusal to Admit Mistakes. Stay humble, stay profitable. Ego can be a trader's worst enemy. It's the refusal to admit you're wrong, even when the market is screaming otherwise. You might double down on losing trades, convinced that you're right and the market is wrong, only to dig yourself deeper into a hole. Remember, everyone makes mistakes in trading. The key is to learn from them and move on. Don't let your ego prevent you from cutting your losses and adjusting your strategy. Stay humble, acknowledge your mistakes, and focus on the long-term goal of consistent profitability. So, there you have it, the 14 psychological traps that can sabotage your trading success. Remember, trading psychology is just as important as technical and fundamental analysis. To combat these traps, develop a disciplined mindset, follow a solid trading plan, and continuously reflect on your behavior. Journal your trades, identify patterns in your decision-making, and actively work on strengthening your mental game. Remember, the best investment you can make is in yourself. Thanks for watching, and don't forget to like, comment, and subscribe for more trading tips and insights.